I think this is where we left off on Monday, if I'm not mistaken. So we started this really important section of the course on the Federal Reserve's operating procedures. And the way I've wanted to kind of frame this discussion over the last class and in today's class is really a study in contrast about how the Fed has very much changed its operating procedure. That is the way it implements monetary policy or targets the federal funds rate before and after the financial crisis. All right, so in the last class, the main takeaway that I hope you guys got from that class was that before the end of 2008, the way that monetary policy was conducted in the United States was that the Fed would set a target for the federal funds rate. That's this interest rate on overnight loans between banks in what's called a corridor system. You guys remember that? So a corridor system was this idea that the funds rate would be established as the equilibrium interest rate in this market for bank reserves, where the equilibrium rate is going to lie somewhere between the ceiling that is set by the discount rate and the floor, which is set by the interest rate on excess reserves. And so the discount rate and the interest rate on reserve balances sets a corridor or a channel whereby the federal funds rate can kind of move in between. And in that model, in that way of describing monetary policy, the intersection of the demand and the supply for reserves always occurs on that downward sloping portion of the demand curve. Okay. Now, one of the key takeaways from that model was that reserve balances would be scarce on the margin, as banks would try to lend out their excess reserves so as to avoid the implicit tax of holding those reserves. And so that's what we saw on this graph right here, was that the excess reserve deposits of depository institutions was pretty low before late 2008, usually less than about $2 billion. And there's a great deal of volume or activity in these overnight lending market. Daily volume exceeded $120 billion for much of that time period. Okay, those are the key features of the Fed's corridor system. The main thing I want to talk about today is the way the world looks after the financial crisis. The way monetary policy is set, the way the federal funds rate is targeted by the Fed is very different in what's called a floor system in contrast to this corridor system. And we'll go through the features in detail today. But before we do that, I want to give you guys an opportunity to practice a little bit more on how to apply this basic supply and demand model for bank reserves in a corridor system, okay? So these would be like the kind of examples you might see on a future lab assignment or on an exam, where I would describe a scenario to you and you would have to model how the Fed would actually change its target for the federal funds rate within a corridor system. So let's go through some of these examples together. And in doing this, I'd actually like to give you guys a chance to kind of explain exactly what's going on here. So let me set up the first one for you. On October 29th, 2008, so right as we were starting to enter into the financial crisis, to help ease the economy, the FOMC lowered its target for the funds rate from 1.5% to 1%. It simultaneously cut the discount rate from 1.75% to 1.25%. This is a big move. Usually when the Fed changes its funds rate target, it does so in 25 basis point increments. So whenever it does it in a 50 basis point increment, that's usually a rather large change in monetary policy, okay? Now, let me ask you guys this. And you can kind of tell by what's happening here on the graph, but at least it gives you a hint. How does the Fed actually carry out or implement this monetary policy here? I want you to tell me precisely what the Fed has to do in order to engineer a reduction in the funds rate from 1.5 to 1%. What are the steps involved in this process? On an exam, I would expect you to be able to illustrate it graphically with clear graphs of the supply and demand for bank reserve, where the axes are properly labeled, where the shifts are identified, where the initial and terminal equilibrium points are. All right, so that's a skill that I want you guys to be able to demonstrate on your graded work. But I would also like you to be able to explain in a sentence or two why the curves are shifting in the way they are. So you guys tell me, how is it that the Fed here would actually engineer this 50 basis point drop in the funds rate target? What do they actually need to do in this case? And what would be the result of those actions? Levi? Oh, yes, okay, go ahead. Perfect. The Fed would engage in an open market purchase of securities with one of these or many of these primary securities dealers. So what does Levi say the Fed is doing here? It's basically swapping reserves for securities. The Fed is taking ownership of those securities and paying for them by injecting newly created bank reserves into the banking system. Levi, what does that do? That shifts the supply of bank reserves directly to the right. Okay? Now, the folks that work for the Federal Reserve have a real good understanding of demand conditions in the overnight lending markets. That is, they know what the slope of the demand curve is. And so they can engineer just the right size open market operation, that is, buy the right amount of treasury securities to shift the supply by just enough to bring down the equilibrium funds rate from 1.5% to 1%. That's how policy is conducted in a corridor system, through regular open market operation, right? Purchasing securities in the open market would lower the funds rate by pushing the supply of bank reserves to the right. Selling securities in the open market would do exactly the opposite. The Fed would then provide those securities off of its balance sheet, and banks would pay for them by drawing down their holdings of reserve balances, shifting the supply curve to the left, raising the funds rate, okay? That's all I'm looking for is bank reserve supply shifts to the right, and that one sentence about why, an open market purchase of treasury security, right? Okay. You'll notice here, though, that since the intersection point still occurs on the downward sloping portion of the demand curve, excess reserves are still going to be scarce on the margin. The funds rate, 1%, is still above the interest rate on reserve balances. So banks are still going to want to lend out as many excess reserves as they can. That is, we're still working within a corridor system here. That's the key difference between the corridor system and the floor system we're going to talk about later today. One more question about this. You'll notice the other part of the scenario says the Fed cuts the discount rate by 50 basis points. How does that happen? And how does it manifest itself graphically here? The discount rate is the effective ceiling for the federal funds rate. No bank is going to borrow in the interbank market at a rate that exceeds what they could get from the Fed, right? And so the discount rate is where this perfectly elastic horizontal section of the supply curve occurs. So if the Fed lowers the discount rate, all that does is actually shift down this perfectly elastic portion of the supply curve by exactly 50 basis points. So there's two parts of the supply curve that shift. The rightward shift is being caused by the open market purchase. The downward shift in the ceiling is being carried out by the Fed simply lowering the discount rate. Remember, the discount rate is not a market rate. It's a rate that's set administratively by the Fed. They can lower it just by announcing it. equilibrium reserves in the banking system would then increase from R1 star to R2 star. Okay, let's try another one. On June 29th, 2006, so let's go back a couple of years here, to slow the economy from this impending housing bubble, the FOMC raised its target funds rate from 5 to 5.25%. They also lifted the discount rate from 6 to 6.25%. Usually the Fed changes the funds rate target and the discount rate at the same time, by the way. All right, again, let me throw this one back to you. How would the Fed engineer this monetary policy operation? That is an increase in the funds rate by 25 basis points. I don't have any coffee today, so I'm not doing as well, I don't think. Exactly the opposite of what they did in the previous example, right? Instead of an open market purchase of securities, the Fed would sell securities in the open market, right? Banks would take ownership of those securities and they would pay for them by drawing down their reserve accounts at the Fed. Again, the analysts who work for the Fed understand the demand conditions in this overnight market well enough to engineer just the right open market sale of securities to lift the funds rate by about 25 basis points. Again, in a corridor system, the equilibrium funds rate is going to be above the interest rate on reserve balances, so reserves will be scarce on the margin. And the way the Fed changes the funds rate is through regular open market operation. Selling securities enables it to lift the equilibrium funds rate by shifting the supply curve back. Buying securities does exactly the opposite. What about the discount rate? If the Fed raises it from 6 to 6.25, then the horizontal segment of the supply curve simply shifts up by 25 basis points. That's set administratively by the Fed here, okay? Now let me ask you one last little kind of tricky question. Not tricky, but I guess it's sort of a trick question. Why is there no horizontal line segment on the demand curve? Remember, the demand curve should have this perfectly elastic component that is determined by the interest rate on reserve balances. And that should set a floor for the federal funds rate in a corridor system. Where is it? Why have I ignored it? Levi? Well, sort of, yeah. Look at the date. June 2006. This was before the Fed started paying interest on reserves. So effectively, the interest on reserves was zero. So in truth, this demand curve goes all the way down to the zero axis and then to the right, okay? Okay, any questions so far? I want to go through this kind of methodically because it's important that you guys understand how to apply this framework. How about reserve requirements? Let's do a couple of examples involving reserve requirements. We haven't talked about that in a while. So the Fed, just so you know, the Fed rarely changes its required reserve ratio, okay? Now, it turns out that, in fact, the Fed did very recently change this in March of this year. And as I've indicated before, it lowered reserve requirements all the way to 0%. For reasons that we'll talk about here in a little bit. But before that point, the last time the Fed changed reserve requirements was way back in, I think, April of 1992. They lowered them from like 12% of deposits to 10% of deposits. Let me ask you just a hypothetical question here. What would happen to the funds rate in this market for bank reserves if the Fed suddenly decided to raise reserve requirements? If bank reserve requirements go up, then that's going to, what are the reasons why banks hold or demand excess reserves in the first place? Go ahead. They need to meet reserve requirements, comply with those regulations, and also to hold any excess reserves to meet their liquidity needs. So what that implies then is if, what's your name? Michael. If reserve requirements go up, then what we would likely see is a rightward shift in the demand for reserves in the banking system, right? Now, without a change in the interest rate on reserve balances, that inelastic component stays the same, right? That's not going to shift up or down. Now, if the Fed doesn't do anything else, what would we expect to see happen in the market for overnight reserves if the Fed simply raised its reserve requirements? Well, the original Fed funds rate was right here at IFF1. If demand now outstrips supply, that's going to put upward pressure on the price of overnight reserves in this highly competitive market. The federal funds rate is going to be bid up, and we would expect to see the equilibrium funds rate rise by some amount. So any effort to increase required reserves in this corridor system would be predicted to raise the funds rate. Now, I think historically, actually, the Fed raised reserve requirements during the mid to late 1930s, so during the Great Depression, and the Fed was criticized heavily for that action afterwards, and it was one of the reasons why a lot of academic economists believe that the recovery from the Great Depression was so slow. It's because through higher reserve requirements, that increased market interest rates and slowed down the economic recovery to a great extent. How about a different question? So let me ask you a follow-up question now. Let's suppose again that the Fed increased reserve requirements, so the demand for reserves shifts to the right here on this second graph. But let's also suppose that what the Fed would like to do in this case is make sure that that increase in the reserve ratio doesn't affect the equilibrium funds rate. Could the Fed do anything here to sterilize this movement in required reserves on the federal funds rate? In other words, could they take any secondary actions that would guarantee that the federal funds rate would not be affected by this change in reserve requirements? What is it that they could do? Go ahead. They could do an open market operation and purchase securities, right? And as we saw on two examples ago, that would shift the supply of bank reserves to the right. And if they measured these demand conditions just right, they could shift the supply curve to the right just enough to restore the equilibrium funds rate at where it was before. So the Fed could accommodate this increase in required reserves by injecting more bank reserves into the system, thereby keeping the federal funds rate the same. That would probably be a better policy if it indeed wanted to raise required reserves. If it wanted to maintain the same type of credit conditions, it should have a simultaneous increase in reserves through open market operation. Again, just this last little point here, the Fed last changed its reserve requirements in March of this year, lowering them from 10 all the way down to 0%. Given the current regulatory landscape, I don't see that changing, but you never know. With as quickly as things change in the federal funds market, it could be very different by next year or the year after that. Okay, any questions so far? Is all of this pretty straightforward? I want you to really get a good handle on how to think about how monetary policy affects the market for bank reserves. So let's work through another practice problem. Okay, I want you to use demand and supply graphs for the federal funds market to analyze the following situation. Let's suppose that banks decrease their demand for reserves. Show how the Fed can offset this change through open market operations in order to keep the funds rate unchanged inside of a corridor system. Why don't you guys take a minute or two and try to sketch the graph of what's going on there, and then we'll go over the answer together. These are important problems to do and will be similar to the types of problems you're going to see on exam. It's really important to me that you guys get a firm grip on how to use this market for bank reserves to think about changes in monetary policy. Okay. Any takers? Who wants to help me out on this one? How can the Fed offset this change in order to keep the funds rate stable? So imagine a situation where banks wake up one morning and for whatever reason, they demand fewer bank reserves. Or all of a sudden people are deciding to withdraw money from their checking accounts less frequently. And so bank reserves are not in as high a demand, right? What's that going to do to this particular federal funds market? Jameson? That's right. So here is our initial equilibrium point. We have our downward sloping demand for bank reserves and our vertical supply, right? Where the funds rate falls somewhere in between this corridor given by the discount rate and the interest rate on reserve balances. Make sure you guys label all of that stuff on your graphs, okay? For full credit, I want to see all of the different rates as well as the curves labeled and the shifts, etc. So like Jameson said, the demand for reserves would shift to the left here. Now, there would be no change in this elastic portion because there's no change in the interest on reserve balances. All else equal, what we expect to see then is that that's going to put downward pressure on the funds rate. Now, supply exceeds demand given by D2, right? People aren't looking for loans in this overnight market as much, and so the equilibrium funds rate would tend to fall. And so, Jameson, what does the Fed need to do in order to accommodate or sterilize this action so that there's no effect on the funds rate? That's right. It wants to shift the supply of bank reserves to the left just enough so that the intersection is at the original federal funds rate. And Jameson, how does it do that? Conducts an open market sale of treasuries. Again, I know I keep emphasizing this, but in a corridor system, interest rate changes are carried out through open market operations, the purchase or sale of treasury securities by the Fed in secondary market. That's very different from what we're going to talk about next. Okay, any questions about that? All that pretty straightforward? Again, save these examples so on the lab, whenever the next lab is, I guess Monday after next, you guys can come back to them and see how to work them, okay? All right, let's move on to the next topic here. And that is to examine this alternative implementation strategy or operating procedure called a floor system. All right, so the financial crisis and the policies that were enacted to deal with its consequences led to some great changes in the federal funds market. As a result of these changes, the Fed was forced to abandon its corridor system for targeting the federal funds rate in favor of an alternative framework, all right? Now look, there were basically three developments that caused most of the change in the federal funds market. I want to talk for a few minutes about those three developments, and then we're going to analyze the situation again in our supply and demand model for bank reserve, okay? The first of these three big changes that altered the landscape of the overnight or interbank market was the change or the dramatic increase in the size of the Federal Reserve's balance sheet, okay? This picture down here, figure 3.3a, shows the Fed's balance sheet. The top part is its assets. The bottom part are its matching liabilities, okay? Now, hopefully you guys can see this. Maybe I should have made the graph a little bit bigger, but between late 2008 and early 2010, the size of the Fed's balance sheet went up a lot, by about 130%, from less than $1 trillion to more than $2.1 trillion, okay? Since that time, since about 2010, the balance sheet has continued to go up at these sort of weird intervals. So later on in 2010, the balance sheet again went up to about 3 trillion, and then in 2012 it went up to about 4.5 trillion. Now this graph stops at the end of 2016, but if we kept going, you would see that the balance sheet actually fell a little bit during 2018 and 2019, but it's ramped back up again and now stands at, I believe, from the last chapter we talked about, the balance sheet is now somewhere on the order of $7 trillion. Now, most of the assets that comprise the Fed's balance sheet are Treasury securities, mortgage-backed securities, as well as the debt of federal agencies, these government-sponsored enterprises like Fannie Mae and Freddie Mac, which I'll talk more about next week, okay? Now, what was the reason for this rapid expansion in the Fed's balance sheet? Well, it was through the Fed's introductions of its large-scale asset purchase programs, sometimes referred to as LSAPs. The other name this has is called quantitative easing, right? The Fed's QE programs, that's what I mean by LSAP programs. Those are the same thing, okay? QE1 occurred in 2008, right? That's where the Fed dramatically expanded its balance sheet by buying up normally unconventional assets. So it used to be the case that the Fed would concentrate on buying 3-month Treasury bills, but these LSAPs or QE programs were more focused on buying longer-term securities like mortgage-backed securities, 10-year Treasury notes, federal agency debt, things like that. QE1 occurred in late 2008, QE2 was around 2010, and then there was actually a third round of quantitative easing in 2012. And all throughout that time, as the Fed's balance sheet was expanding, the liability side of the balance sheet was also going up. And what is the main component of the Fed's liabilities? It's reserve balances in the banking system. That was the outcome of these QE or LSAP programs, was this huge increase in bank reserves in the banking system because the Fed had to buy up all of these assets with something, all right? That was the biggest and most dramatic change in the landscape of the federal funds market post-financial crisis. This idea that QE essentially flooded the market with excess reserves among all of these banks. It's the first thing you got to remember. Now, one final point I'll make about this is that really the reason why the Fed engaged in these QE programs was to try to provide additional support and liquidity to particular markets. The housing market was obviously the one that was in great distress during the financial crisis. So when the Fed buys a boatload of these mortgage-backed securities, what is it doing? It's taking those assets off the market. It's reducing the supply of those assets in secondary markets. That raises the price of those assets and lowers their yield. That helps spur economic activity and supports growth in those key markets. That was really what QE was all about. QE was not necessarily about lowering interest rates as it was providing liquidity to certain markets in the economy so that they can continue to function. The drawback or the byproduct of all that was this huge expansion in bank reserves. And so what happens now, pretty much all banks in the economy are awash with excess reserves. Pre-crisis, remember, excess reserves are scarce on the margin. Post-crisis, everyone has a ton of excess reserves. That changes the way the federal funds market is going to play out. Okay, questions about that? So that's big change number one. The second change that I want to spend a few minutes talking about is a couple of key regulatory changes. So while the Fed was busy responding to the crisis with these multiple rounds of quantitative easing, QE 1, 2, and 3, Congress was busy trying to respond to the crisis by passing this enormous piece of legislation, you might recall, called the Dodd-Frank Act of, I think it was 2013 was when it was finally passed. Now, this was a huge piece of legislation. It had lots of different features and empowered a whole lot of new agencies to do different things. But there was a small but rather significant change that came about as a result of this legislation that altered the FDIC's regulatory standards. Now, let me stop right here for a minute. Hopefully, you guys have heard of that outfit before, the FDIC, the Federal Deposit Insurance Corporation. What does the FDIC do? You guys know? Jameson? They insure retail level deposits. When you guys go and put your money in a checking account or a savings account at a bank, if someone robs that bank, or if there's a run on that bank, your deposits are going to be insured by the FDIC, right? Now, how do banks provide that insurance, or how do banks have to pay the FDIC insurance fees or premium in order to have that coverage, right? But that insures retail level deposits. Now, a little known change at the time actually had a big effect on the federal funds market, okay? Prior to the financial crisis, prior to the enactment of the Dodd-Frank Act, 2010, by the way, not 2013, the way that the FDIC assessed its fees on banks changed compared to what it is today. Before the Dodd-Frank Act, banks would be charged an insurance fee based on the amount of deposits that it had, right? So the insurance fees were based on the total amount of checkable deposits that were held at that particular bank. And that makes sense, okay? However, after the Dodd-Frank legislation was passed, there was a change in the regulations where now banks are going to be assessed fees not on the size of their deposits, but actually on the size of their assets. Remember, individual commercial banks have liabilities and assets. Their main liability are the checkable deposits that people have made at those banks. The assets that banks have are things like Federal Reserve overnight balances, right? Commercial reserve balances. And so because reserves are counted as an asset for commercial banks, as soon as the FDIC changed the way they assess these fees from deposits to assets, that actually increased the cost of banks holding and acquiring even more excess reserves, right? Because now every time a bank wants to increase its reserve balances, the fees that it has to pay to the FDIC are actually going to go up, right? So you see how that increases the cost then for commercial banks of actually acquiring reserves in this overnight interbank market, okay? Now, it may not be obvious to you yet why this is important. And believe me, this will become more important next week when we talk about some of the difficulties that the Fed has in actually targeting the funds rate in a floor system. But what I want to point out right now is that even though I don't really have this directly in the slides, the FDIC levies these fees only on banks that have domestic U.S. deposits. That mainly is U.S. banks. That's who falls under the regulatory umbrella of the FDIC. Who falls outside of that regulatory umbrella? Well, it would be foreign banks that have domestic branches. Foreign banks typically don't hold U.S. deposits. However, foreign banks have reserve accounts with the Fed, okay? And so for foreign banks like Barclays or Deutsche Bank or one of these type banks, they didn't face the same cost of acquiring overnight funding in the federal funds market like domestic banks did, okay? I don't have this in the slides spelled out exactly, but I want you to remember this when we go into next week, because this strange regulatory feature actually changed pretty dramatically who was participating in the federal funds market. With these additional fees, domestic banks had less of an incentive to borrow and lend in the federal funds market. And it was going to be, there was more participation coming from foreign banks that didn't face those same FDIC fees. Okay, I point that out now because I think it's important, and we'll come back to it next week. The last significant change in this landscape for the federal funds market was, of course, in October of 2008, the Fed began paying for the first time interest on reserve balances. And at the time, it was a small interest rate of only 0.25% or 25 basis points. Now, the hope or the goal at the time was for the Fed to be able to place a floor under which other short-term market interest rates, like the federal funds rate, would not go below, as we've described earlier in this course, right? Prior to October 2008, the Fed didn't pay interest on excess reserves. And so what banks would want to do then is loan out those excess reserves so that they avoid the opportunity cost of holding them, right? But once the idea here is that with interest on reserve balances, the opportunity cost that banks face is now going down. So there's not as much of an incentive then for banks to actually loan out excess reserves in this interbank market because the implicit tax is now lower. Now, you may think that 0.25 percentage points is not a lot, and it isn't, but at the time, other market interest rates were also very low. So this was one of the best rates that commercial banks could actually get at the time. Right, so the punchline here is that interest on reserves lowered these costs, and therefore they increased the incentive for banks to accumulate more and more excess reserves. One other point I want to make about this, and again, it will become of great importance next week when we talk about some of the challenges of targeting the funds rate in a floor system, is that it turns out that the interest rate on reserve balances was not actually made to every financial institution. That's why I have here in this parentheses, interest on excess reserve balances of many, but not all depository institutions. Domestic commercial banks that have reserve accounts with the Fed could earn interest on reserves of 25 basis points. But not every financial institution was eligible. There were some eligible and ineligible financial institutions, all right? That actually created a mismatch in the federal funds market, which made it somewhat difficult for the Fed to be able to actually precisely target the funds rate. So just bear that in mind as we go through this discussion today, that this interest on excess reserves wasn't actually available to all financial market participants, only mainly US commercial banks. Okay, you guys have any questions then about that? So during this transition then to the floor system in the post-crisis era, the Fed's operating procedures changed because of these three big reasons, right? The Fed started paying interest on reserves. These LSAP or QE programs greatly expanded the Fed's balance sheet and therefore flooded the banking system with excess reserves. And there were also changes in the regulations surrounding the FDIC. And so now there are different participants in the federal funds market. What I want to do for the last 30 minutes of class today is talk about how these changes can kind of manifest themselves in our supply and demand model for bank reserves, and how we can use it to analyze how monetary policy is set in what's called a floor system. This is now the way policy is being conducted today. Okay, so let's start with our basic supply and demand model for bank reserve. Now, given the three major changes that we've just talked about, how is the demand and supply model of bank reserves going to look different relative to the core? Whoa. That is a roach. Did you all see that? My gosh. Wow, that's never happened to me in 10 years of teaching here. Roaches in the classroom. All right, so let me get back to this graph. So how do those three changes in Federal Reserve, in the federal funds market, show up in this market for bank reserves? Well, with such a huge increase in excess reserves, basically what happens here is the supply of reserves is going to shift to the right way far out to a point at which it intersects the same old demand curve on this perfectly elastic portion of the demand schedule. Okay, now in this environment, what is the equilibrium federal funds rate going to be equal to? You can tell immediately from the graph. It's got to be at the intersection of supply and demand, right? Well, the equilibrium funds rate then is going to be simply equal to whatever the interest rate is on reserve balances, okay? Now, that's the key distinction between a floor system and a corridor system. In a corridor system, the funds rate is between the discount rate and the interest rate on reserve balances. In a floor system, the funds rate is just set at the interest rate on excess reserves. Now, again, how does monetary policy work in a corridor system? If the Fed wants to change the federal funds rate, what does it do? It conducts open market operations and moves around the supply of bank reserves to move up or down the federal funds rate, because the intersection point always occurs along this downward sloping portion. How does the Fed target the funds rate in a floor system, however? Levi? This is the key difference that you have to know. Corridor system pre-crisis, the Fed conducts policy via open market operation. Post-crisis, the way the Fed moves the federal funds rate around is simply by announcing changes in the interest rate on reserves, which is an administrative rate. It is not a market-determined rate. Levi, when that happens, if they want to raise or lower the funds rate, they simply raise or lower the interest rate on reserve balances, and that will lift up or down this perfectly elastic component of the demand schedule, okay? Now, let me take this back just a second. Let's think about this for a second. What would happen if the Fed conducted an open market purchase of securities in this floor system? In a corridor system, that would lower the federal funds rate because the intersection is over here somewhere. But what happens if the Fed conducts an open market purchase of securities in this world where the intersection is way over here on the perfectly elastic portion of the demand schedule? Jameson? Supply would shift right as the Fed acquires these securities. Bank reserves would be injected into the banking system. The supply of bank reserves would shift right just like it did before, but it would have no effect on the equilibrium federal funds rate. Why? Because the funds rate is being pinned down by the floor that is set by the interest rate on reserve balances. So whereas in a corridor system, open market operations are used frequently to move around or target the funds rate, in a floor system, open market operations are not going to be used as frequently. But instead, what the Fed is going to do, they're going to raise or lower the interest rate on required and excess reserves to move the funds rate up or down. Of course, this can only happen if the intersection point occurs here way out on the flat portion of the demand curve. Now, what have I done with the discount rate? The discount rate has not gone away. It's still there, but this perfectly elastic portion of the supply curve now becomes kind of irrelevant to the funds market. Why? Because the federal funds rate is simply going to be pinned down by the interest rate on reserve balance. That's why we call it a floor system instead of a corridor system. It's the floor that is determining the equilibrium funds rate rather than the corridor between the discount rate and the IOER rate. Jameson, yeah. Well, you could put it in there if you want. I eliminated it just to emphasize the point that the discount rate doesn't really matter for the setting of the funds rate anymore, because the funds rate is no longer going to fluctuate in that corridor between the discount rate and the interest rate on reserve balances, but rather it is actually being anchored down by the interest rate on reserve balances. And if the Fed wants to move the funds rate, it does so by moving this administrative rate rather than by conducting open market operations. Do you guys see the fundamental difference there between these two systems? It's important to me that you get that. But we can couch the whole discussion and these differences between pre and post-crisis monetary policy in the same framework. That is this overnight market for bank reserves, the supply and demand curve. Okay, let me talk briefly here about some key points about the floor system that I want you to recognize. And this is going to mirror, in a lot of ways, the discussion from the last class. So in a floor system, the equilibrium funds rate no longer depends on the exact quantity of reserve balances in the market, right? Instead, it's determined by the interest rate on reserve. So in this floor system, the federal funds rate is not married to the quantity of reserves like it is in a corridor system, but we say it's kind of divorced from the quantity of reserve, right? In other words, this gives the Fed basically two policy instruments. In a corridor system, the funds rate target and the supply of reserves are really one and the same thing. You can't move the supply of reserves around without also changing the funds rate. In a floor system, you can move the supply of reserves around and the funds rate stays the same. So this actually gives the Fed an additional policy tool. Now they have interest rate policy, that is the interest rate on excess reserves, and they have credit policy, right? That is things like QE or LSAPs, which expand the amount of reserves in the banking system. All right, so from that perspective, the floor system dominates the corridor system because it allows for this divorce to take place, and it gives the Fed actually two policy instruments that are separated from one another. Another key point, because the federal funds rate is equal to the IOER rate on reserve balances, there's no longer going to be an active interbank market for overnight commercial reserves, right? If all of these banks are now awash with reserves, you're not going to have as many banks seeking lending in that particular market. They don't need to. They've got plenty of excess reserves, okay? Well, a drawback from that is that any role that this market might play in gathering information about the creditworthiness or the health of different banks in the banking system is going to be lost in a floor system. I think this is an important point. One of the most useful features of a corridor system is this active interbank market allows participants to see what banks are healthy and what banks are under distress. But in a floor system where there's not an active interbank market, that information content is lost, particularly to the regulators. Point number 3, excess reserves are now going to be abundant on the margin. So they're no longer going to be scarce, they're going to be abundant. Huge quantities of excess reserves are expected to prevail. one last point I want to make about this. A floor system, and this would be, I guess, an advantage over the corridor system, is that it eliminates this implicit reserve tax. That is, right, if the funds rate is above the IOER rate, banks want to lend excess reserves to avoid that tax. That creates this hot potato problem that we talked about in the last class, where one bank was always trying to lend to another. And there's resources wasted in trying to constantly lend that money in overnight markets, all right? When the funds rate is equal to the interest rate on reserve balances, that hot potato problem goes away, right? There's no longer an implicit tax imposed on excess reserves. And so banks don't waste resources trying to find clever ways of unloading those excess reserves. Some data on these key points. And again, I want you to contrast this to what we saw in the pre-crisis corridor system. The first graph shows the path of excess reserves in the US economy. Now, remember the graph of excess reserves that I showed actually at the beginning of this class. They were around $2 billion, right? These little wiggles down here between 2006 and 2008 was that part of the graph, right? Now the scale here is much higher. What happened to excess reserves as soon as we transitioned to a floor system? They exploded, right? And so by 2009 or 2010, there were $1 trillion worth of excess reserves in the banking system compared to something like $1 or $2 billion prior, that is in the corridor system. So excess reserves indeed became abundant at the margin, just as our supply and demand model would predict. By 2012, excess reserves were approaching $2 trillion. So orders of magnitude higher than the amount of excess reserves we saw in the banking system under the corridor system, pre-financial crisis. Here's another interesting graph, and again, this is just a copy of the graph from earlier in the slides. This is the total volume daily of trading in the interbank market. What do you see happening right after the financial crisis as we transition to the floor system? Daily trading in that interbank market goes way down. It goes from like $140 billion a day, quickly down to around $50 billion per day. And by 2012, we were closer to $20 billion per day. Why? Commercial domestic banks were awash in excess reserves. They did not need to lend or borrow. Also, the FDIC was now assessing fees on banks' assets, that is, their reserve balances, imposing an additional cost of acquiring reserves in this market. But it didn't impose those fees on everyone. Particularly, these foreign banks with domestic branches are still trading in this overnight market. So trading doesn't go away altogether. It's just being dominated by different players in the financial system. Next week, we'll talk about who's actually doing these particular trades and why this became a problem for the Fed's ability to target the federal funds rate under the floor system. Okay, any questions so far? How are we doing? Aside from the roach that tried to dive bomb me. I haven't seen it since, so. Yes. They do. Yes, they do. And no, so again, we're gonna get into this next week, but yeah, in the past year or so, there actually has been more domestic activity in the interbank market because of other failings of the Fed's floor system. So the Fed transitioned from this corridor system to a floor system, and it actually hasn't been 100% successful. Let me show you. This actually brings up the point you just raised, and it's going to foreshadow what we're going to talk about next week. Here is a graph that shows two interest rates. The red line is the interest rate on excess reserves, starting in 2015 and going all the way through 2020 August data. The blue line is the effective federal funds rate. Okay? Yes, you're not seeing things. What do you notice here? That during this whole post-crisis period, the effective federal funds rate would wiggle around in about a 25 basis point range, but that range was always, at least until 2018, below the interest rate on excess reserve. Now, wait a minute. We just got done talking about at length now about how the interest rate on reserves was supposed to provide a floor that the federal funds rate could not go below. How can the funds rate go below the interest rate on reserve? Well, that's a rhetorical question, actually. We're going to answer that more fully next week. But what I want to point out to you right now is that the Fed's floor system hasn't really been 100% successful. That from 2015, at least till 2018, the federal funds rate was persistently at a level of about 20 to 25 basis points underneath the interest rate on excess reserve. So in fact, the Fed's floor was not a floor at all. It was more like a leaky floor, right? The funds rate was always dipping below the interest rate on excess reserves. Well, that's a problem, because if the Fed wants to conduct monetary policy by moving around the interest rate on excess reserves, if the funds rate is always below it, it can't be certain then that if it raises or lowers the interest rate on excess reserves, that the funds rate is always going to move in tandem with it, right? That there's some gap between the two that the Fed can't control perfectly. Now, it does turn out that as the Fed lifted its interest rate on excess reserves, the funds rate did go up accordingly, but it never was pinned directly to the IOER rate. It was always trading a few basis points below. Now, what's your name? Say? So this is, I think, probably what you were referencing here. So in very recent years, so in late 2018 and through much of 2019, actually, what do we see happening? The federal funds rate was again trading above the interest rate on excess reserve. Well, again, how is that happening? In a floor system, the funds rate should be pinned down directly by the IRB rate. But yet for several years it was below, and then during this kind of 1 year episode, it was consistently above. And in fact, there were some points where it spiked quite a bit above the interest rate on excess reserves. So like you pointed out, banks were actually going to the interbank overnight market and trying to acquire liquidity. And as a result, the federal funds rate was actually spiking in certain periods. So the point of this is to show that the Fed's floor system has not been perfectly successful, that there are some challenges that the Fed faces in trying to implement monetary policy under this new system that it did not face prior to the crisis, when all it had to do was conduct open market operations. I know all of this stuff is technical, okay? But this class is called Monetary Policy and Theory, right? I can't just teach you monetary policy from a previous era. I've got to teach you about how monetary policy is conducted today. And the reality of it is that the Fed doesn't quite have everything figured out, in my humble opinion. They're still evolving and trying to figure out how policy needs to be implemented in this post-crisis era where we have abundant excess reserves. And what experience has told us is that the funds rate is sometimes below and sometimes above what the Fed is establishing as its target. And it has to take other actions to try to actually control the funds rate, which will be the big topic of next week's classes. Okay, you guys have any questions so far? I only have a few minutes left, so let me try to get through the last couple of slides. I may not quite get all the way through, but now that we've examined the Fed's policy tools, these open market operations, reserve requirements, discount policy, and interest on reserves in some detail, both in a corridor and a floor system, I want to talk a little bit more about how these tools are actually used in practice and importantly, how their usage has changed over time. I think some of this stuff is important so that we can place policy actions in a greater context or a broader context. First off, let me talk about open market operation. So the Federal Reserve Act of 1913 actually didn't even mention open market operations, okay? And the reason why is because at the time, these open market operations really weren't well understood, right? The Federal Reserve Act really just established the Fed as a lender of last resort to provide liquidity through the discount window in these emergency situations, right? But ever since the Great Depression, the Fed's primary tool, at least up until the crisis, has been open market operation, okay? The Fed at the time didn't have a firm understanding of what these things were. In fact, the Fed more or less discovered open market operations by accident. And the way that happened was that during the 1920s, some of the Federal Reserve district banks actually acquired these things called World War I Liberty bonds that were issued by the federal government from commercial banks. So commercial banks had purchased these Liberty bonds in primary markets. Then some of the Federal Reserve district banks turned around and bought them directly from the commercial banks. And what that enabled them to do was enable these banks to actually finance more business loans, right? They were able to sell those assets for reserves that they can then loan out to other businesses during the roaring 20s, which is what they wanted to do at that time. So this is the sense in which the Fed actually kind of accidentally discovered open market operations, is through the purchase of these World War I Liberty bonds during the 1920s. Now look, these purchases were quite limited, and there was no coordinated action among the district banks to conduct these open market operations. And so this ended up being quite a big problem during the Great Depression. And so in 1935, Congress amended the Federal Reserve Act to create what we recognize today as the FOMC. That wasn't part of the original Federal Reserve legislation. The FOMC's primary responsibility was to coordinate nationally the purchase and sale of securities, that is, open market operations. Okay. Before 2008, or up to 2008, the Fed used these open market operations to adjust the supply of bank reserves so that it could target its federal funds rate, right? Now, of course, today, as we just got done talking, these open market operations aren't used as much. They're mainly used today to either expand or shrink the Fed's balance sheet separately from their interest rate policy, but they're still important, right? Okay, so that's kind of the history of open market operations that I think is pretty interesting. Let me talk now a little bit about how open market operations are actually conducted in practice, how they're carried out. I think it's probably good that you guys understand procedurally how this is done. Up till this point, all we've basically said is the Fed buys or sells Treasury securities in secondary markets. Well, how exactly does that play out? So at the end of every FOMC meeting, which occurs about once every 6 weeks, the FOMC issues a statement to the public. That statement includes two things primarily: a target for the federal funds rate, along with some assessment of the overall economy. That's their justification for either raising, lowering, or keeping the funds rate target the same. I don't have time for this today, but if you guys follow this link, it'll take you directly to a calendar where you can read these public statements on the Federal Reserve's website. Now, In conjunction with this public announcement, the FOMC also issues what's called a policy directive directly to the account manager of the Fed's account who is responsible for implementing these open market operations. This account manager is a vice president of the Federal Reserve Bank of New York. The New York Fed has a special role in the Federal Reserve System because it's at the New York Fed that engages in these open market operations directly, okay? Specifically, these open market operations are conducted by what's called the Open Market Trading Desk, or just the desk for short, at the New York Fed. Given its proximity to Wall Street, this is ideal and most convenient, and the trading desk is linked electronically to these primary government securities dealers that I've talked about a little bit. If you follow this link to the New York Fed's website, you can see the list of 24 primary securities dealers that the Fed engages open market operations with, okay? So the account manager, that is this vice president of the New York Fed, receives this policy directive, and it's that person's responsibility to carry out open market operations in an amount or in a frequency sufficient to meet the policy directive, that is to hit the federal funds rate target as closely as possible. Okay, so how does that work? At the beginning of every day, if the Fed needs to carry out an open market operation, what it does is it notifies electronically all 24 of these primary dealers about the size of the open market purchase or sale that it wishes to carry out, okay? And it asks these primary dealers to submit bids. All of this happens, by the way, pretty quickly at about 9:30 in the morning Eastern time. The primary dealers have just a few minutes to submit their bids to buy or sell. And what the account manager does is he looks over those bids and accepts the best ones, the ones that are the most profitable for the Federal Reserve System. So that's how open market operations are actually carried out in practice, by the account manager at the trading desk of the New York Fed, who's electronically linked to these 24 primary government securities dealers. Lastly, let me talk just briefly here about two different types of open market operations that I think you should know something about. One is called a dynamic open market operation, and the other is called a defensive open market operation. A dynamic operation is one that's intended to change monetary policy as directed by the FOMC. For instance, if the policy directive says raise the federal funds rate by 25 basis points, the open market operations that are required to keep the funds rate permanently higher at 25 basis points would be a dynamic open market operation. Those only occur when the funds rate needs to be changed from where it currently is. Most often, the type of operations that the New York Fed engages in are what are called defensive operations. And that's because on any given day, there's going to be small shocks to the demand and the supply of bank reserve that cause the funds rate to move around. And so what the Fed has to do then is they have to offset those supply or demand disruptions through open market operations to try to defend the funds rate target, okay? Now, the way they do this is by carrying out what are called repurchase agreements, or repos. And again, we'll talk more about this next week, but what a repurchase agreement is a transaction between the Fed and a dealer, sometimes it's just called a repo, where the dealer agrees to sell a security, like a T-bill, to the Fed one day and buy it back the next day or a few days later at a specified price. In other words, a repurchase agreement is basically a short-term loan that a dealer takes from the Fed, right? But that loan is collateralized by a security. It's a secured loan. Unlike interbank lending, those are unsecured loans, okay? That's what a repurchase agreement is. The Fed can inject bank reserves into the banking system temporarily by engaging in one of these repo agreements with a dealer, by injecting bank reserves in exchange for a security, and then the very next day, returning that security, but getting the bank reserves back. The difference in the price there is what determines the interest rate. What's a reverse repo? It's the exact opposite. The Fed can temporarily withdraw bank reserves from the banking system by engaging in a reverse repo, where the Fed this time sells a security off its balance sheet to a dealer and then agrees to buy back that security the next day at a pre-specified price. So when you guys hear me talk about repos and reverse repos in the overnight secured markets, these are defensive open market operations. These are used far more frequently by the Fed than these dynamic open market operations. I wish I had more time to talk about this. It pains me to have to talk about repos and reverse repos in the waning minutes of the class, but it is what it is. So I might be able to review these concepts a little bit at the start of class on Monday. But for the rest of the class, we're going to start our next section on, it's called Monetary Policy 2. And we're going to discuss these various implementation challenges. So mainly why the Fed funds rate has not been able to stay anchored to the interest rate on reserves in the last several years. Okay, we'll talk about those difficulties. Okay, that's all I have.